Capital Economics has issued its latest update on the prospects for the global economy. Here to discuss the findings is the company's chief international economist, Julian Jessop. Thanks for being with us. So if you don't mind me saying, it kind of makes for depressing reading. We've peaked. The global economy's peaked. You see slower growth in 2011 and slower again in 2012.
I mean, certainly I do feel a bit like Scrooge at the moment, and bar humbug might be what I should be saying. But I think the bigger picture is that we are having some additional temporary stimuluses thrown at the world economy, in particular the huge fiscal stimulus now coming through in the US. But the very fact that we need more stimulus, I think, is a reflection of the underlying weaknesses in the global economy and the fragility of private sector demand. So the fact we're still so dependent on the US government and also the Chinese government in fueling a credit boom over there, I think is actually quite worrying.
So what are the big risks, themes as we move ahead? I mean, we've still got the European debt crisis, and you just mentioned China.
Well, I think there are a number of risks going ahead. I think, first of all, you're right to focus on Europe. Although the headline GDP numbers for the Eurozone as a whole are picking up, that reveals underneath that huge divergences between the core and the periphery. So I think continued financial crisis in the periphery is going to keep people nervous about the European economy. Elsewhere, there's still a huge imbalance between the US and China. I think China's trade surplus is going to be even bigger next year than this year, so that will keep the risk of a US-China trade war alive. And in the rest of Asia, I think the Japanese economy is deteriorating at an alarming rate, and the next financial crisis might even be in Japan.
Well, you're predicting a possible double dip for Japan.
Yes, I mean, people have known for a long time, of course, about how awful the state of the public finances in Japan are. But in the last year, at least, that's been masked by quite a strong economic recovery. But if we're right that the economy in Japan might be heading for a double dip, then I think the government is going to be in an awful bind ahead of the required tax increases over the next few years. It may well let the budget spiral out of control, and that could cause a financial crisis, which in many ways would have parallels with what we're already seeing in Greece and elsewhere in Europe.
Right. Now, how do you think this European debt crisis is going to play out? Do you see some sort of breakup of the Eurozone?
Well, we actually think there's a better than 50-50 chance that the Eurozone will break up. Probably not in the next few years, maybe in 3 to 5 years' time. I think there's just enough political will to keep it going through 2011, maybe 2012. But underlying all of this, as we economists like to say, the Eurozone is not an optimal currency area. It doesn't make sense for these countries all to have the same currency and the same interest rates. Ultimately, we think something will have to give. It's only a question of will it be a country like Greece leaves, or maybe even Germany.
Now, given this cautious view of the global economy, you're also making some predictions about gold, raising your price target to $1,600 an ounce in 2011 and $2,000 in 2012.
Well, exactly. I think over the last few years there have been two reasons to buy gold. One is inflation fears and worries about the dollar. I think those fears will fade. But the other is the concern about a series of economic and financial shocks that might hit the world economy. And I think there are at least three. I've mentioned some of them already: the EMU breakup risk, the possibility of a US-China trade war, and a potential financial crisis in Japan. I think all of those factors may well favour gold prices and push them significantly higher.
Okay, Julian Jessop, our Scrooge. Thanks very much.